and gentlemen, and thank you very much for joining us for our class on Fibonacci retracements, brought to us today by LegacyFX, one of the world's leading providers of CFD and Forex. Legacy is a fully regulated and licensed Forex broker. And if you want during class, you can go to www.LegacyFX and open a demo account and start trying out their MetaTrader 5 platform. It's the most powerful platform in the world, and it gives you financial market analysis with charts and technical indicators. User-friendly interface, you can either download it or use it on a web browser, or you can download it in an app and put it on your Mac and your smartphones. Whatever way you want to trade, you can use one way or all of them. It's up to you. But you can go set up a demo account and follow along using their advanced charts on their desktop platform or on their web platform. While we're in class, there's no credit card, no deposit required, and you can start adding Fibonacci retracements onto your charts to see how they work. Now, with the MetaTrader 5, you can also add expert advisors, algorithmic and automated trading. You can build your own black box system. So feel free to go to www.LegacyFX and click on Open a Demo Account. And no time at all, you'll be able to download the MetaTrader 5 platform. They've moved up to the most recent. And you'll be able to check it out and try it out all you want. Now at Legacy, their philosophy is that they cut through all the excessive jargon and financial content and talk to you in a language that's comprehensive to all. They have competitive trading conditions. They're fully compliant. They offer you free trading tools and simple and fast trade execution and withdrawals. They have a wide range of tutorials and courses in their Knowledge Center. They offer live webinars, periodical market research and analysis, and many trading tools that you need to make smart decisions. You also, as a trader with Legacy, get access to AutoChartist, one of the world's most leading providers of charting and technical analysis software. With AutoChartist, you'll be notified and they're constantly scanning the markets. It'll give you trade alerts. You can set up what you want to see, when patterns arise, what things you want to have. You can set up all types of customizable searches, and you can set it up to integrate directly onto your MT5 platform. Now, since Legacy is a regulated provider, I am required to give you a risk warning. And once we get past this, we'll be ready to talk about Fibonacci. Trading Forex and contracts for difference are complex financial instruments that are traded on margin. Forex and CFDs carry high levels of risk since leverage can work both to your advantage and disadvantage. As a result, CFDs may not be suitable for all investors because you could lose all of your invested capital. Please make sure you understand what you're doing and seek independent advice if necessary. Now, today's class is being recorded. If you wish to see a recorded version of today's class, you can do so in about 24 hours by using the same link you used to come to the live class. Or when investing.com has had time to edit and clean it up, you'll be able to find it on the investing.com website, where you register for this webinar, under the Education tab, and then Webinars on Demand. And in fact, there you can see all the webinars we've given in the last 7 years. So when you have a chance, go to investing.com, go to the Education tab, and then look for Webinars on Demand and watch whatever subjects are of interest to you. So let's get started how you can identify turning points with Fibonacci. Now, we have to do a little bit of background before we can go on and just place Fibonacci on charts, because you need to understand where these ratios come from and how they are important to you, or why they're important to you. Now, Fibonacci ratios come from the Fibonacci sequence. And this sequence is something it's one set of numbers. Everybody in the world has them. You can figure them out if you want, but they go on to infinity. If you take 0 and add it to the next digit, which is a 1, and then take 0 and 1 and add it together, what are you going to get? You're going to get 1. If you take the preceding number and the 1, add them together, you're going to get 2. Take 2 and the preceding number and add it together, you'll get 3. Take 3 and the preceding number, add it together, you get 5. So all you're doing is adding the preceding number to the new total number and putting it onto your sequence. Okay, these numbers don't vary. They are always the same. There's no other mathematical calculations. It was said, I remember when I was in school, I think they told us that it was what a mathematician observed in the reproduction of rabbits. But so 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233, 377. But you never have to remember them. You never have to use them. You'll never have to go back and say, oh, what's that Fibonacci number up in the 700s? Doesn't make a difference to you. But we can take this sequence and convert it into ratios. And the amazing part is when we apply these ratios, they exist all over the known universe. They have nothing to do with the financial markets. These ratios have existed, and the sequence existed for hundreds and hundreds and hundreds of years before there was ever a financial market. So, and I tell you, once we get through this, you'll never have to do it again, but you should understand. So if you take the number and divide it by the previous number, anywhere in the sequence, but if you take the beginning of the sequence, remember it was 0, 1, 0 plus 1 gives you 1, 1 plus 1 gives you 2, and 1 plus 2 gives you 3. So if we were to take this part of the sequence, and that's only because this is where it's used in the example, and we were to take 3 and divide it by 2, it would give us 1.618. If we were to go to this area and take 21 and divide it by 13, it would give us 1.618. If we were to go farther up to the 3421, 1.619. These all are approximations, and they all come out always to 1.618. And in Fibonacci terms, we call anything above a 1 an extension. Below are retracements. So if we were to take the same numeric sequence and reverse it, instead of taking 21 and dividing by 13, we would take 13 and divide it by 21. We would get 0.619. Go farther back and do 21 and 34. We would get 0.6176. We would go all the way up to 55 and 89. We get 0.618 also. So these all come out to be approximately, or the number we use is 61.8. And if we were to take this number and subtract 61.8, what will we end up with? 1 all the time. So we have 1.618. Then we have 0.618. Then if we were to go back a wee bit farther, and instead of 1 digit next to it, we were to go back 2 digits. So in other words, we're going to take the 13, and if we were to take the 12, the 13 and 21, that would give us 34. So if we were to take the 13 and divide that into 34, so we're skipping every other digit, that would give us 0.382. And so on all the way up into infinity. So if we were to take 55 and 144, it would give us 0.382. And if we were to take 1, that same one we got before, subtract 618 this time, we would get 382, which is this retracement. And we could keep going farther and farther back. We could take 13 and jump 3 digits over, and we would take 13 and divide it by 13 and divide it by 55, and we would get 0.213. This would give us our retracement at 2136. So what do we have? We have 2, 3, 6. We have 3, 8, 2. We have 6, 1, 8. And if we were to go a half a digit over, we would get 78, 6. And we're not going to worry about extensions beyond 1 right now. Now, there's something radically missing in this. And everybody's, I'm sure, has their hands up and saying to me, where's 50%? Well, 50% retracement does not come from Fibonacci levels. It's got absolutely nothing to do with fibs. It's got to do with Dow theory, and it was developed and introduced to the financial markets by Charles Dow. And it was his belief that when a price rallies in the market and goes up, when it moves the other way, it will retrace 50% of its prior move. It was so popular that it is, and since it's a retracement number, it has been automatically kind of added in the financial markets and the Forex markets into our charting as a fib level. But technically, a 50% is not a fib level. But the extension when we talk about the 1.618, we've known from Greek agriculture, from Greek architecture. We've known if we lay out the galaxies throughout the world, it's called the golden ratio, or the golden mean is referred to as phi. And the inverse of that is the 1.618. The portion of 0.618 to 1 is the mathematical basis for the shape of playing cards, for the Parthenon, for sunflowers, for snail shells, Greek vases, and spirals in the galaxy. Now, the funny part is, even if you put it onto human anatomy, it said that if you take the spirals or the ratios between your eyes, nose, ears, and mouth, and the closer they are to the Fibonacci ratios, the more attractive the face is. Not the prettier you are, but the more attractive it is to someone's eye. And it really holds true. Why? We don't know exactly why. It just is. It's part of nature. Now, when we apply it into the financial markets, we have found that when price pushes up, it will tend to fall back down to some significant levels. Not that it's not going back up. Price moves and push, ease, push, ease, push, ease, push, ease. Price doesn't move straight like that. When price is moving up or down, it tends to retrace itself to one of these levels, 38.2, 50, which again I told you is not part of fibs, or to 61.8. Now you can get a steeper retracement at 78, but that is about the end of it, and you can get a smaller retracement at 23. Most people don't use the 23 or the 78. The most common are 38.2, 50, and 61.8. This comes about because when price is moving up, you have buyers, 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 buyers entering the market, buying, buying, buying. Okay. At some point, those buyers who entered here have said, okay, I'm going to exit the market at this level because that's the profit I wanted from my trade. They've already set up their limit order, and they start selling because this is a level that they thought they wanted to sell at, and they've set up their sell orders. Okay. So also at some given point, the buyers who are all buying in the market start moving to the sideline because they're saying, that price is a wee bit too high to buy right now. And at some given point, as price begins to ease down, it would have cleared out all of those sell orders, and those buyers sitting at the sidelines will be starting to go back into the market to push it back upward. This tends to happen as price eases down. If we believe in these levels, you can watch as price retraces down to this level. And that doesn't mean it's got to stop at 38.2 at all. But if it doesn't stop at 38.2, we'll be watching 50%. Doesn't stop at 51%, 50%, we'll be looking at 61.8. 61.8 is really the last step of the line where before we can say, because the buyers that are sitting on sideline are looking for some clue to re-enter the marketplace. So once a stock begins to pull back or retrace, then we can plot these retracement levels on a chart and look for signs for a reversal. Okay, so how do we put this grid or these fib levels on our chart? Okay. So in order to find these Fibonacci retracement levels, you have to find the recent significant swing high and swing low. Then for a downtrend, click on the swing high and drag the cursor to the most recent swing low. For an uptrend, do the opposite. Now, it's what you're looking for is the previous move, not the current move. So price is easing back down as it had moved in an uptrend. What we're looking for is the swing low and the swing high of that uptrend based on the fact that it was ending. Okay, we need the previous move. So we would locate the swing low and then the swing high, and I'll show you how to do this on a chart in a minute. And we would then pull our tool straight up from this line to this line. It'll do everything else for you. You don't do any calculation. You don't have to pull and do anything. You're just simply telling the tool where the swing low and the swing high is. And then the tool will lay it all on your charts and will give you. So here we see the 23.6, the 38.2, the 50, 61.8, 76.4 retracement levels. And we do just the opposite in a downtrend. So let me share, I've got this in a little presentation, and then we'll go on and talk about how we might want to use these in our trading.
Mathematical equations and strategies out there that try to make sense of a market that is largely speculative. However, it is widely accepted among traders that rely on technical analysis that most major moves will retrace around the Fibonacci levels, and more specifically around the 50% level of the move. So in an uptrend, a price will retrace down a certain percentage of the move before continuing its long upward movement. Likewise, in a downward trend, the price will move up a certain percentage before continuing its long-term downward movement. If the price moves beyond the 50% level, it might be a signal a trend reversal is about to happen, and it may be an opportune moment for switching the direction of your next trade. In this tutorial, we will simply refer to the Fibonacci retracement tool and how to use it. We will be explaining the mathematics and more on Fibonacci in following video tutorials. So traders use these Fibonacci levels as efficient entries in the direction of the trend, because many traders watch these same levels and place buy, sell, or stop orders based on them. They are quite accurate and become a self-fulfilling prophecy. So how should you enter in an uptrend? You can use the Fibonacci retracement levels for an entry into the market. For an entry in an uptrend, you should look to see whether the price finds support at these levels. Then we suggest you wait for confirmation that the price will move back into the original upward movement and then enter. As with any technical indicator, it is better to seek additional indications to support your initial analysis so that you don't base your trade solely on Fibonacci retracements. Look for clear signals to buy or sell. For instance, wait for a candlestick to close in the desired direction to give you more confirmation on whether you should place an order. If it does form, you can place a market order at this point, as you have solid reasons to believe that this level could hold. How to enter in a downtrend. Likewise, for a downward trend, you can place your entry after the price has found resistance at one of the Fibonacci levels. After you wait for confirmation that the price will move back into the original downward trend, you can place your entry order. So how to place your exit. Now that you have decided on your entry, you need to determine your exit strategy. Your exit strategy is comprised of two steps. First one is deciding where to place your stop loss, and the second is where to place your target profit. Let's look at the same graph that we had for our upward trend. Here we suggest you place your stop loss just below the retracement level. In a downward trend, we suggest you place your stop loss just above the retracement level. Where should you take profit? And now for the best part, your target profit. If we use Fibonacci retracement levels to forecast entries into the market, we can use Fibonacci extensions as reasonable profit targets. Fibonacci extensions make good potential take-profit levels for trades in the direction of the trend. Similar to the retracement levels, the key Fibonacci extension levels are 38.2%, 50%, 61.8%, as well as 100, 138.2% and 161.8% extension levels. The Fibonacci extensions correspond to retracement levels, making it all very simple. If you enter at 50 or 61.8%, a good take profit is the corresponding extension level at 161.8%. Let's go to the Trading 212 Pro platform to demonstrate how to use the Fibonacci.
So you've now seen how you would put these on your chart, and we're going to go over some live charts and do this together. The key, well, there's a couple things we need to keep in mind. These are not, even though the tool puts them on as precise prices and precise levels on your charts, these are not exact numeric values. Because if you notice, when we built the sequence originally, it was 1.618, and the next number was 1.615, and the next one, and they averaged out to 1.618. Or when we looked at the approximate, the 30 to 61.8, one was 61.79, one was 61.82, one was 60, and the approximation is 61.8. So these are, and keep in mind at all times, they are zones, they're alert zones. Don't go back. I've seen people say, well, I'm going to buy it at exactly that 38 2-point level, and that's at 171.42, and they're going to put their entry order at 171.2. But that's just an approximation. Just like when you set your take profit and your stop loss. Yes, if you're entering at 61.8, set your take profit at 161.8 of that number, but it's in a zone. You have to use other indications to finalize that exact number. And one of the keys that will make you better than the guy next to you when using fib levels is figuring out where you put your swing high and swing low. Okay. Because yes, you can look at a price chart and you can say, that's a swing low because that's the lowest price that asset hit before it reversed. And that's a swing high because that's the highest high it hit. But it's not a significant swing high or swing low. And this is what we want to get, is the significant price, the significant turning point. So some definitions go as far as saying a swing high is a candlestick with at least two lower highs on the left and the right of its side. A swing low is a candlestick with at least two higher lows on both the left and the right side. Okay. I personally use my eyes. You can see what price was a pivotable price when that asset reversed its course. And this is what you need to use when you're putting your tool on your chart. So let's go over to live chart. Hold on a second, let me pop up a chart. Oh, and before we go on, if you notice on your screen, there are two handouts. One is the Fibonacci retracement guide. This is a guide that goes over everything we do in class today and goes over with charts and explanations in detail for you. And then the other is the technical analysis guide from investing.com. That is a great resource guide. It covers all of technical analysis. You can use it at your leisure. Now, there's nothing you have to do for these. There's no registration, no login, no nothing. Just click on the download buttons, download them to your computer. They're PDF files. Use them at your leisure and move them around to whatever device you want, but you can only get them in this live class. Okay. So now we are looking at just the euro pound chart, okay? And we need to identify the last swing low and the last swing high of the previous move. Now, it's kind of hard to say what we have right here, because this could be considered the previous move, because we moved all the way up and then we crashed down. Now we're recovering. Or we could look at this longer move, or we had that move. Now you can have overlapping Fibonacci levels on your charts. And a lot of people use that because when price was moving up here, and then it reversed to move down, you would have put your fib levels on there because that would have been the most current price movement. So if we were just to move this chart to the wall here and say, this is where we are right now. Well, we would identify a significant swing low. And that is there. We'd identify a significant swing high, and that was right there. That's not very hard to do, was it? It's visually easier to do. It happens to be in this chart. It's very easy to see. We would then go up to our fib tool. We click on here and we come down to our Fibonacci retracement tool. And then we would start at our swing low and we would pull it up to our swing high. Now, we can set the colors, we can set the levels, we can do whatever we want here. So let's change some colors here. And the only thing we're concerned with right now is 38.0, 38.2, 61. We're going to keep an eye on the 78.6 and the 50. One of my colors change. Let's do red here. And we now have them laid out on our charts. I don't know why it's being so difficult here. Let's go. Okay, so it's laid out on our charts now, and we can see over here on the right, this is our 78.6, our 61.8, our 50, our 38.2, our 100. Now, we laid that out when price was trading here and this was the wall. Well, or when price was trading here and this was the wall. Well, then price moved into a downtrend and it completed that downtrend. So what we would do, if that's the most current price move, let me get some of these markings off of here. We would then, again, significant swing high, significant swing low. Now, here's a toughie. Where would you call it? Would you call it here? Would you call it here? Would you call it here? By our previous definition, I would call it here. So therefore, we take our Fibonacci retracement tool, and we would take it from the swing high to the swing low, and this would be the opposite because we're coming off of a downtrend to an uptrend. Now here, we would then identify, but remember, each one of these are at the wall. So it's only the ones we can see when they take place. So now, we have our most current one. Now, isn't that kind of amazing how all of these that were drawn completely independently all lay over top of each other. Now, if we want, we can take this one off our chart, or a lot of people use multiple fibs. And also we can see price climbed all the way up to here. It dropped, and where did it fall back to? Look at how that 78.6 held. And now where's price moving back up to is that 100%. We can see we had the open and close right here at 38.6. 50% paid very little except right there in the little gap. And the other thing is we change, as we change time frames, we don't change our fibs. And look at that, we get to see a clearer vision of the fibs when we change it to a different time frame. But we don't go back because the swing low and the swing high are still the same. So now we have our Fibonacci levels on our charts. What do we do with them now that we got them on our charts? Well, retracement levels alert traders or investors of a potential trend reversal, resistance area, or support area. Retracements are based on the prior move. A bounce is expected to retrace a portion of the prior decline, while a correction is expected to retrace a portion of the prior advance. Once a pullback starts, chartists can identify specific Fibonacci retracement levels for monitoring. As the correction approaches these levels, chartists should become more alert for a potential bullish reversal. Now, keep in mind what I just said to you a few minutes ago, is that these retracement levels are not hard reversal points. Instead, they serve as alert zones for the potential reversal. It is at this point that traders should employ other aspects of technical analysis to identify and confirm a reversal. They include candlesticks, price patterns, momentum oscillators, and moving averages. What I like to do is I always use support and resistance, okay? But I use eyeballing support and resistance. When I drop my fib retracement tool on my chart and I see how it's lining up with a significant support level, resistance level that I got in another fashion, that tells me that that price has a lot of significant importance as the price is moving. Now, again, there are certain levels. We consider 23.6 to be a relatively shallow retracement. Such retracements will be appropriate for flags and short pullbacks, but we really depend on the retracements from 38.2 to 50, and they're considered moderate. And even though deeper, the 61.8 retracement can be referred to as the golden retracement. It is, after all, based on the golden ratio. A lot of people say that 61.8 is the farthest that you can go, but technically, we have another important level below that, and that's the 78 level. Now that is a deep, deep, deep retracement. But there's all types of strategies for trading the 78 level, because it said that you're getting an asset at its cheapest price possible. Now, if you've been paying attention in class, you know by now that you can combine the Fibonacci retracement tool with support and resistance levels and trend lines to create a simple but super awesome trading strategy. When combining the Fibonacci retracement tool with candlestick patterns, we're actually looking for exhaustive candlesticks. If you can tell when buying or selling pressure is exhausted, it can give you a clue of when price may continue trending. So if you can see a bullish or a bearish engulfing candle or retracement that's happening at a fib level, it can help magnify the importance of that level. So exhaustive candles can help you, engulfing candles can help you. Bullish or bearish, unique candles can help you when they're right at those support and resistance levels. And as I mentioned earlier, and we mentioned in a little presentation, you can use fibs to put your entry points, your exit points, and your stop loss points. Using a fib for a stop loss approach is especially interesting because it offers a more objective way of placing stops. Whereas the trader has to make decisions subjectively when to move a stop based on a moving average or swing strategy, Fibonacci levels don't have that component because Fibonacci levels don't move or change. So once a trader has drawn his fib levels, they don't have to move anymore and potential stop losses can be well defined. So if you were looking at entering at the 38.2 fib level, you would place your stop slightly beyond the 50% retracement level. And you would set your take point profit point at what? If you're entering at the 38 level, at the 138.2, or if you're taking it at 161.8, at 161.8. Now, the truth is, just like in combining fib retracement tools with support and resistance levels, trend lines, and candlesticks to find better entries, it would be best to use your knowledge of these tools to analyze the current environment to help you pick a good stop loss. As much as possible, you shouldn't rely solely on fib levels as support and resistance points as the basis of your stop loss placement. Now, again, if you see an overlap between different fib level, between a fib level and a support and resistance level that comes from a different technique. So you got it from your trend line, you got that fib, that level from eyeballing. Okay, that makes that level much more significant, and then you could use that to set up your stop loss. So the first thing you should know that about Fibonacci tool is that it works best in trending markets. So I'm going to share with you a very unique strategy to see how we would use fibs entirely to set up an entire trade strategy and an entire strategy using the 78.6 retracement level.
Take a look at Fibonacci in the real world. What we're looking at is gold. So I'm going to do a couple of historical examples to show how it might have worked, and then a current example on gold. So let's pretend it's the end of February. So we're here. We've watched gold go from these December lows around about $1,120 an ounce up as high as here, up as high as sort of 1260 area recently. And it starts to come off. So we think, right, I'm going to use my Fibonacci retracements to try and figure out where the price of gold might stop sliding and bounce and continue this trend. So let's put the retracements on. So we pick them up from here. We start at the beginning of the move. So I click down there and then drag it all the way up to the high. And it puts the retracements on for me. Let me just adjust this one down here. There we go, that's better. Like a lot of software, it does include some additional Fibonacci levels, but the main ones I'm worried about, let me just make this a bit clearer. I'll right click, change the color, make the lines a bit thicker. Here we go. So what I'm looking at is the 23.6, the 38.2, the 50 and the 61.8. So if the Fibonacci is going to work, the market's gone up, and then we're looking to see if these levels, the 23.6, the 38.2, the 50 and the 61.8, do they support the market? Let's just walk through and see what happens next. So these are daily candles, don't forget. So the market's selling off. So we're on the 23.6 level now. That's broken, it's gone through that. So the next one to watch for support is the 38.2 at 1209. That's gone again. We can see it breaking through. And the next level we're looking at is 50%. So the market's gone from here up to there. And now if it gets to this level, it's dropped back 50%. That's our next Fibonacci level. So let's just push it forward. And actually, it looks like it's working. So the market went from X to Y, dropped back 50%, and the market has recovered. Let's have a look at the next rise. What happened next after this? The market did push higher up to here, just back up near that old high and started coming off again. So again, let's, as usual, let's just adjust our lines. So we'll pick it off that high there. And again, we're just trying to see now what happens. Does the market hold on these old levels. I think it's pushed just a little bit higher. So let's just nudge it up to that high up there. There we go. And it started coming off. So our 23.6% level is at 12.54 an ounce on gold. Then we've got 12.28 and a half. That's our 38% retracement. And then the 50% is there at 12.08. And then the 61.8% is there at 11.87. So let's just walk through and see what happens next. The market's sliding. So it's taking out that 23.6% level. So 38.2, that's the next level to watch. It's taken that out. But so far it's holding, and once again the 50% retracement level has worked. So it took out the first two Fibonacci levels, but the market did move higher again. Okay, so now this is an up-to-date chart for gold up until the end of last week. So the market had pushed higher beginning of June, sold off. Let's put our Fibonacci levels on. Let's take them again. Let's take them again from the start, from down here. So from those lows in December up to the most recent high, beginning of June. Again, I'll right click, make this a different color so we can see it. There we go. So the market slid off, has slid below 23.6. At the moment, it is holding above that 38.2% retracement at 12.30-ish level. And if that level breaks, the 50% one to watch out for is 12.10. So there might be a couple of levels, if you're a fan of Fibonacci, to keep an eye on for gold in the days to come.
So that's one way that we would use Fibonacci in our everyday workings. Now, Fibonacci retracements are often used to identify the end of a correction or a counter trend bounce. Corrections and counter trend bounces often retrace a portion of the prior move. While the short 23.6 retracements do occur, the 38.2 to 61.8 cover the more possibilities, with 50% in the middle. This zone may seem big, but it's just a reversal alert zone. Other technical signals are needed to confirm a reversal. Reversals can be confirmed with candlesticks, momentum indicators, volume, and chart patterns. In fact, the more confirming factors, the more robust the move is or the signal is. So fibs are a very easy tool to add to your charts. They're not a complicated tool to add to your interpretations. You can easily add them into your other trading strategy. Like I said, what I look for is the multicollinearity between my support and resistance levels that are already on my charts from eyeballing and the current support and resistance levels that come from the Fibonacci levels. And when they coincide together, that gives me a significant level or price point that I'm looking for to expect a market reaction. So thank you very much for joining us today. If you have any questions, go to www.LegacyFX.com, click on their live chat button or send them an email, and a financial analyst will be glad to call you and explain your questions and help you get all of this figured out. So thank you very much and have a great trading day. Bye now.